Well, it's old news that the Reserve Bank raised interest rates in November, but in this week's Property Insider chat, Dr. Andrew Wilson and I explain why they did it, and Dr. Wilson's going to give his thoughts about when and if they're going to raise rates again and what that means for our housing markets and our economy. We're also going to talk about rising building costs and the latest home loan data. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. Well, it happened again. The Reserve Bank hiked interest rates last week, ending a 4-month reprieve for mortgage holders. It was amid renewed fears that inflation isn't falling fast enough. Now, of course, that happened on Melbourne Cup Day, and the winner of the Melbourne Cup might have been called without a fight, but the opposite was the case for the new governor of the Reserve Bank, with Michele Bullock telling us that progress towards the bank's inflation target of 2 to 3% was too slow. So as a consequence, she was prepared to fight, and she did, by raising official interest rates. So what does this mean for homeowners and property investors? That's what I want to ask Australia's leading independent housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. And I also want to chat a bit about some of the other statistics this week that are going to give us a clue to what's ahead for housing in Australia. Hello, Andrew.
Yeah, good morning, Michael. And it was no surprise that we got an interest rate increase. The narrative changed at the previous meeting. The minutes clearly showed that there was a change of sentiment from the Reserve Bank. Look, we've been questioning the Reserve Bank's decisions since they decided to pause back in May, and clearly they've gone too soon, even though they've waited until inflation started to move in the wrong direction from their perspective. Really, all the other drivers of inflation, particularly the labour market, were continuing to show a very strong economy. So there was no justification, in my opinion, for a rate pause. And there were many, many factors, or a number of factors anyway, which supported that position that we went too early. And I think what was interesting at the time, Michael, and still is now, is that, and we can't absolutely compare ourselves to other similar economies, is that the US official interest rate is over 1% higher than our rate, and yet their inflation rate is nearly 2% lower, their underlying inflation rate. So, and it's a similar situation in the UK and the Eurozone. So I guess we could look at that comparison and suggest that quite clearly we went too early, and that's allowed or continued to have a higher inflation rate, particularly compared to our major trading partners, particularly US. It was inevitable that we would see a tightening again. We won't look too deep into the reasons why the pause was earlier than perhaps the data justified, but nonetheless, the new governor has really had to reverse the position, and it's a bit of a similar theme with the Reserve Bank's policies, I believe, Michael, over the last 3 or 4 years, with interest rate policy not really matching existing conditions and then having to change quite rapidly as that became apparent. But look, at the end of the day, inflation is driven by too much demand. The main driver of demand is people with jobs, and that's why the labour market is a key indicator, and it hasn't shifted the slightest really since we began to raise rates. If anything, it's tightened, Michael, and we have probably the strongest labour market in our history. And of course, that's driving demand, and we need to see signs, real signs, not nibbly little side positions, that the labour market is fundamentally starting to shift before we see demand declining and therefore inflation falling. So I believe, Michael, and here's a bit of a tip, that following on the Melbourne Cup theme, I suppose, that we may even get another rise in December.
Well, obviously the Reserve Bank's raising interest rates to bring inflation under control, and Michele Bullock warned that inflation is going to stay higher for longer. And in her discussion, she blamed older Australians as they're still able to spend. Clearly, some people are hurting. The budgets are hurting. Boy, when I actually had a look at what the price of petrol was on the weekend, I've never seen it as high as that in Melbourne. And I know some people are tightening up their discretionary spending. But higher interest rates aren't affecting everybody, are they?
Well, no, Michael, but I think the blame game seems to be part of what the Reserve Bank's having to use as its mechanism to support the flip-flop of its policy position. I would have thought that, okay, baby boomers and what are they, people over 65 are not part of the workforce as a proportion as those in younger demographics who would be more inclined to be impacted by a weakening labour market through higher interest rates. And everybody's affected, as you mentioned, by higher prices at the moment. Fuel, but it's everything else as well. And we're seeing services prices really increasing. And the Reserve Bank governor mentioned that that was an issue that they're concerned about, service price increase. But they've certainly changed their position. And in my opinion, they just went far too early. And just the comparisons with the US are a clear example of that.
Let's have a look at a couple of other clues in the news that are going to give us some indications of what's ahead. One of the leading indicators, things we look at to give an indication of what's ahead moving forward, are home loans. Over the last little while, there's been some new data.
Yes, we've had the September data released by the ABS for home lending. We saw another rise, a marginal rise really in home lending for overall. But when we look for the breakdowns, we can see that owner-occupier lending, home loans altogether up by 0.9% over the month. The trend is certainly upwards, which we shouldn't be surprised at, given the strength of most of our housing markets this year, which will record, most of the major capitals will record 10% plus prices growth. So we would expect more lending to be occurring in that environment, especially the value of lending, Michael. But the value of lending up 0.9% totally for home loans, nationally, seasonally adjusted. I still think we've got some issues with the ABS home loan seasonal adjustment model, but nonetheless, the trend is clear. But I thought it was interesting, Michael, with the home lending data, and as we've mentioned here before, the ABS halted its first home buyer data set. It said that it couldn't rely on the data and that what it was getting from APRA, and they were working with APRA to tighten up that first home buyer and the banks, the first home buyer lending data. So they've reintroduced that, Michael, over September. So we've got the full data series now. And interestingly enough, the difference in the first home buyer data that's now come through is showing a weakening data set. In fact, noticeably weakening when compared to investors and total owner-occupier lending. And when we look at the comparisons there, we can see that investors were actually recorded one of the stronger positions for over the month. The year so far has also been a positive for investors in terms of losing activity over that period. But the first home buyers were down by 2.4% over the month. That's a concern, I suppose, but not a surprise, Michael, given that we do have higher interest rates. We do have, of course, a very tight rental market with rents skyrocketing over the past year and generally the highest inflation in decades. And of course, we have higher house prices as well. As I mentioned before, house prices up generally in the major capitals by around 10% this year. And that again just means it's tougher for first home buyers. So no surprise that we're seeing a decline in first home buyer activity compared to investors, which are still on the rise and which I guess makes sense with higher house prices encouraging investors into the market and overall owner occupiers still rising. So I thought that was interesting in terms of the impact on first home buyers and clearly being shown with that weakening ABS trend.
Andrew, we recognise that one of the challenges the housing market's got, the big one, is lack of supply for rental accommodation as well as new dwellings. And part of the problem is it's just become too expensive to financially bring on new developments. Developers aren't prepared to take the risk, and even home builders are having difficulty. So I know my housing market keeps a careful tab on what's happening with house building costs. We've now got some latest data giving us an indication.
Well, yes, Michael, and we know that we had a surge in house building costs as a result of that home builder policy of the previous government. Annual house building costs were increased by as much as 25% at the peak of the cycle around about a year ago. But of course, supply has started to catch up with demand, and we've seen a downward track in the annual growth rate. But the index itself is still rising, Michael, or has been rising. In fact, concerningly, last month, the August data showed an increase again in house building costs following what was a flattening trend. But this month, with some better news, we've seen that there was a steady, well, they fell just marginally, the house building costs over the month. The My Housing Market House Building Cost Index was down just slightly, so we could call it a flat result, which was an improvement certainly on the previous month, which showed an increase. The positive news in terms of, I guess, the inflation rate was that we saw a fall in the monthly index of house building costs that are taken over the year. In fact, down to under 10% now. We'd seen over the past 3 months that the annual index of monthly house building costs, or the annual change in the monthly house building cost index, had actually started to increase, and it had moved above 10% to 11%, but it's tracked backwards over September, Michael, now up by 9.6%. I mean, still way too high, of course, and it is comparing to what we saw a year ago, so fluctuations will occur, but certainly we've recommenced a downward trend in the annual growth of house building costs, Michael, which is a positive for inflation if that continues, but still obviously putting pressure on builders having to cover those increases in building costs. But there was no increase per se over the month of September compared to August, so we can hope that we'll start to see a downward trend and get back to a more normal environment for house building costs, because as you suggested, it's a significant factor in so much of what's happening in the housing market, particularly the rental market. Just another factor that's constraining supply in an environment where we've got booming demand.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now, I enjoy getting your auction results first before the others. On Saturday night, you report them on LinkedIn and we report them on Property Update. And it was interesting to see how the auction markets responded to a rise in interest rates and a little bit more stock after a quieter weekend with the Melbourne Cup weekend. How did things go last weekend, Andrew?
Well, it was interesting, Michael. As you say, we had the interest rate increase. Lots more stock, particularly in Melbourne, coming off the back of the previous weekend's holiday for the Melbourne Cup. But I thought it was a reasonably steady result, given those factors. I don't think there was a real response to the interest rate increase. Of course, a lot of the sales are already locked in prior to the interest rate environment. But look, we're in that period now where we're tracking back towards the end of the season. 5 weekends left, Michael, and then that's it for the year. And we always see clearance rates falling or easing regardless of the cycle during this period. We do get higher stock numbers, and that's because we're not getting the same sort of turnover, because those buyers who were selling and then buying obviously are constrained by buying because of the holiday period that's coming up. So that takes some buyers out of the market. You know, some sellers start to become a little bit more circumspect about selling close to Christmas. Yeah, so we're starting to see that end of season energy, which typically gives us a lower clearance rates and, of course, reflecting higher stock numbers. So at the weekend, we had another big weekend in Sydney for auctions, still tracking around about year highs in Sydney, 862 auctions. Clearance rates were steady at just over 70%, which is still a reasonable environment for sellers, that sort of a clearance rate, and still well above where it was a year ago when we also were starting to see an easing in clearance rates. Melbourne, big weekend, nearly 1,000 auctions, well above, of course, the previous weekend holiday numbers, which were low. Again, the Melbourne clearance rate held firm at around about that 66% rate. Again, a reasonable result for sellers. The market's evened out in Melbourne between sellers and buyers over the last month or so. But again, as I said, these are the seasonal impacts that we typically see through November into December. Brisbane, steady also, steady auction clearance rate and with similar auction numbers. Adelaide was down a little bit, didn't get its 80% result that we typically expect from Adelaide, but still the best result of all the capitals. And again, Canberra, very similar results, similar auction numbers and a similar clearance rate. I guess we could say that was situation normal to some degree on the resumption following the Melbourne Cup, and notwithstanding, you would have expected perhaps some sort of an impact on some with that interest rate increase, but it was probably fairly generally flagged that we were going to get an increase.
Andrew, I think you're right. Nobody wanted it, but I think most people expected the interest rate increase, didn't they?
Yeah, they did. And I think perhaps people realise that even though it's always tough to get a mortgage increase, we do have a very strong economy. We are struggling, I guess, generally to counter higher prices. But at the end of the day, the biggest discretionary consumer item that we have is our homes. And we've had plenty of action in the housing market this year, despite high interest rates. So that hasn't really constrained that activity. And I think going forward was just a normalised market to some degree, Michael. This is what you'd expect this time of the year and with higher listings, and I don't think there was any impact at all through interest rates. However, it'll be interesting if we do get a follow-up interest rate increase, and I don't think we should discount that chance in December from the Reserve Bank, because at the end of the day, it's going to be a while before they're meeting again. I would have thought that if they're concerned that they need to sort of act sooner rather than later to try to quell, even though obviously there's not a lot of action that happens through the holiday period, I think there's a compounding effect there which will impact when the economy returns from holiday in February.
One of the things they look at is retail spending, and it's all been brought forward. So in the next couple of weeks, there's going to be the Black Fridays and all those other events that are going to encourage people to spend. It'll be interesting to see if we've got the ability to spend our cash.
Yes, Michael, it's been, there's really no sign of a significant easing in spending, and we need that to quell inflation. And, when we look at the trends for our auction market, that confirms that it's easing as we typically see as the season unfolds and concludes. But we're coming from some very strong results through autumn and into June with that catch-up market. The trends there in most of our capitals. Sydney's still tracking above 70% in November so far. Melbourne at that 66% result. Again, they're all down on their previous peaks. Brisbane similarly, and Adelaide, even though it was under 80% so far this month, is still a strong auction market. And perhaps Canberra's been the underperformer of all the major capitals. So I think it was a fairly reasonable and expected result to some degree, the auction markets, and we await, as I said, I expect to see lower clearance rates, but it's been a very strong year. I mean, any year where we've had months of near 80% clearance rates in our major capitals has got to be a positive year.
Very few people would have thought this was going to be the case if you look back 12 months ago. I know it was actually this time last year that you were calling changes in asking prices and in the sentiment, saying the market was going to move ahead. But most people at this time last year would never have dreamed we'd have this sort of a run of auctions.
Yeah, that's right, Michael. And it's interesting, commentators are still picking up in isolation on the strong prices growth this year and not realising that we're still not back to where we were in the major capital. Well, in Melbourne and Sydney anyway. We're not back to where we were at the beginning of last year at the peak of the post-COVID cycle. So we've really only just caught up with what we lost last year. So any sense that we've got an unbalanced housing market in terms of prices, we're still not back to peak levels in Melbourne and Sydney. In fact, Melbourne's still 3% below where it was 18 months ago, which means there's still good value opportunities there for buyers in that Melbourne market, which has probably surprised slightly on the downside this year compared to the other major capitals. But I think that still represents good value going forward for that Melbourne market.
Right. Well, we'll be back each week to discuss what's moving in our markets and the factors that are going to direct which way they're heading. Look forward to catching up with you again next week, Andrew.
Yeah, thanks, Michael.